Hello and good morning, listeners. Welcome back to Almus Market Mornings, your morning brew of global financial updates with Jayaram Krishnamurthy. Now, folks, we've had quite a bit of data points to ponder over in the last couple of days. And to start it off, it can be with the domestic trade deficit. Trade deficit increasing, by the way, because the exports fell and the imports increased. Along with that, we had US inflation and the retail sales numbers. Now, JK, interestingly, even though the retail sales number suggests an increase of 2.6%, on the inflation adjusted terms, it has declined by 0.4%. And likewise, we've been observing a lot of flip sides on the number of data points being released. So what's your take on the financial updates and how's the financial markets tracking these things?
Hey, good morning, Shikhar. Yes, sometimes 1 week can make a huge change to the markets, and that's what we have seen, in the last 7, 8 days. Because the previous week was one of extreme pessimism and also, risk aversion, and this week we have seen the entire thing reverse, if not fully, but reverse significantly. Because the wall of worry, that the people had about hefty rate cuts by the Fed is beginning to crumble, and sentiment is improving on basis of fundamental report. Yes, as you said, the headline numbers are good, but then if you go deeper, they're not as good. But then markets are, right now going by headline numbers, and as we said, the retail sales increased by 1% month on month, and compared to a revised 0.2% drop in June. So basically, if you look at it, it's a month-on-month improvement. That is what we have seen in the retail sales. Not that, in real terms, it is definitely down, and that is not something the market is valuing right now. And also, one definite change was the weekly jobless claims that came at 2,27,000 versus 2,34,000 that was seen last week. So there were 2 weeks of significant drops that we have seen in the weekly jobless claims, and it was this, the higher number that we saw at 2,40,000 odd was also due to the strike in automakers. That was seasonal shutdown that was happening. That is one real good news. But then if you look at the other manufacturing, industrial production, Philly Fed, all that has actually coming weaker. In any case, the manufacturing sector has been going a big slowdown. But these numbers have actually somehow given way to market now reducing substantially about their 50%, 50 basis points rate cut from Fed in September, and it is now well into the 25 basis points cut alone, which market is discounting. And even the 1% rate cut probability, although it stays, but then the probabilities of that is somewhat lower. It's more like a three rate cuts this year that the market is looking at. But I think risk sentiment improving also had something more real on the basis of Japanese GDP that surprised to the upside quite a bit, and then even the UK GDP came higher for the second successive quarter, and so this is actually helped the improvement in sentiment. Inflation CPI on Thursday, or rather on Wednesday, did not hold in major surprise, unlike the PPI, which came lower. So it's market is latching on to the good news, and not so much onto the negatives which were in the focus earlier, and also improving the sentiment is no escalation of geopolitical tension either in the Middle East or in the Ukraine region. We had big rise in the bond yields yesterday after the retail sales data. 2-year went up by almost 15 basis points, and then 10-year went up by 10 basis points, although they have slightly moderated in Asian times today. On the stocks, Nikkei has now recovered 20% from the lows, and Nasdaq has recovered 12% from the lows. So these are real measures of the market improving. But whether they will continue, I think looking at the massive carry positions that exist in the market, and also the fact that Japan is on a hiking path. Only the timing is question means that this risk rally is not going to be as deep as we used to before the Japanese changed their monetary policy. So expect some moderation in these rises. Of course, we will wait for the Jackson Hole meeting, which is coming up next week, where Powell and other central bankers are likely to talk about the monetary policy. Yes, definitely Powell's words about upcoming meetings and prospects of rate cuts would be very much on the radar of the traders. I think we will see some consolidation ahead of that, because in all likelihood, Powell will play down the market, against the push back against the market's rate cut expectations, and that will actually see the markets somewhat, giving up their bullish stance on the rates. On the dollar, index has quickly bounced from the crucial level of 102. It's now trading about 1% higher from there, mainly helped by the dollar yen, which has gone up. Of course, euro also one more failure at 1.1050. And the Eurozone data yesterday was not helpful either. Because the industrial production was down big time. So other currencies like Audi and CAD are the ones which are performing much better now, because improving growth conditions in UK, Japan, and also US not slumping as much as it was perceived earlier, help the commodities to recover. So that again helping the commodity currencies. And of course, the Australian central bank remains quite hawkish still. On the rupee, yes, the deficit was higher last month because of lower exports and higher imports. Exports falling is a slight concern, but that is also down to some slowdown in some of the countries in the global economy. So that maybe this is a cyclical thing. But overall, if you see for the quarter, the net of merchandise and services deficit has only marginally gone up, and that seems to be well manageable because of the strong flows that we have. So just to give you a perspective, the private receipts alone this year is likely to cross 125 billion. And apart from that, we are having FII flows, which has crossed 15 billion this year. And FPI flows are likely to increase as we go along. Of course, in the short term, we are seeing a stalling in the inflows because of various uncertainties, particularly the regional disturbances. Investors still assessing what impact it will have on the US economy, in the Indian economy. So India is on the sideline right now, not so much in the focus, because it has had a strong rally, and the rupee, of course, has irrespective of where the other segments of the Indian market are, rupee has been rock steady, held by RBI, and 84 seems to be a very strong resistance, unlikely to break unless we have a very big negative news. But on the downside as well, we have 85 as a strong support. Let's see what triggers the break of either of these. Yes, have a good weekend. Thank you.
That was good, JK. And I'd really like to start off with something that you mentioned. I mean, yes, there are, it's something Vladimir Lenin mentioned, that there are decades when nothing happens and there are weeks where decades happen. So yes, we have had a quite interesting week. And even though, JK, there was this one interesting thing that I saw, even though there was drop in the jobless claims, but if you'll also dig deeper, only 1 out of the 4 unemployed Americans have filed for the unemployment benefits for the jobless claim. So technically, we are still looking, if we deep dive, the numbers are really not positive for the US economy, as they've been rolling out the reports. And even though the cursory numbers have shown some sort of reduction in the rate cut expectations, we are still observing how things go about for the rate cut scenario of US, as well as the other nations or the other economies who are already on the path. But there's quite good surprise, as JK mentioned, on the GDP front for Japan, as well as a positive number for UK, although Euro continues to struggle on its recovery path, as the lower industrial production suggested yesterday. And that has led to some sort of, support by the dollar index visible, or support taken by the dollar. So it needs to be seen how things go about in the coming days. On the domestic front, as JK mentioned, we are expecting $125 billion worth of private receipts. There is already a flow of $15 billion by the FIIs, and there can be some more by the FDIs as well. So on the flow front, we still see it on the positive side. So a trade deficit narrowly increasing may not be that significant, as JK mentioned. Any which ways, folks, that's it for today, and we shall keep observing and bringing in all the latest financial updates for you. Meanwhile, have a good weekend, and let's close it by saying thank God it's Friday. We shall come back again on Monday. Thank you so much.